Session of Cap. Good morning, everyone, and welcome to the second session of Capitalize 2024, brought to you by the Alumni Committee in collaboration with FPSP India. After a great start to the series, we are excited to continue with today's session on personal income tax, a topic that affects each of us in our financial journey. We are honored to have you with us today, sir, Mr. Balwant Jain, a renowned tax and investment expert. Mr. Jain is a chartered accountant, company secretary, and certified financial planner with extensive experience in the field. He is a regular contributor to leading business channels and publications and has conducted numerous workshops across India, empowering individuals with his insights on personal finance and taxation. Moderating today's session is our alum, Sanika Joshi, from the batch of 2023 and currently a senior analyst in strategy and transactions at EY. We are thrilled to have you all here and we look forward to a highly insightful session. Without further ado, I now hand it over to Sanika to begin the session.
Thank you, Kushi, and good morning to all of you all here. It's an honor to be a part of this session with Balwant Jain today, and we would love to be enlightened by all the tax advice that we could gather today in this session. And so I think I would just like to deep dive straight into a question that is something that's pertinent in the sense that recently we had the introduction of another tax regime. So now we have the old tax regime and the new tax regime. So, sir, it would be great if you could highlight what are the benefits that can be claimed under the old tax regime, which are not available in the new tax regime? Yeah. And is it possible to switch on an annual basis?
So, first of all, let me thank K J Somaiya Institute as well as for inviting me, and Khushi for the kind words of introduction. The government wants the taxpayers to disclose their real income and do away with all the exemptions and deductions. And with this purpose in mind, the government had introduced new tax regime where the taxpayer had to pay tax on his real income at a lower rates. So before I elaborate on what are the benefits not available, I would rather say what are the benefits which are available if you opt for old tax regime. So for salaried employees, you can claim HRA, you can claim LTA, you can claim deduction for home loan in respect of interest paid for self-occupied property, and all the deductions under Chapter 6A, which include Section 80C, which comprises of EPF, PPF, life insurance policy, ELS, school fee of children, life insurance policy. There are many avenues available under Section 80C, then ATD, Mediclaim, then NPS, bank and saving bank interest, etc., which are exclusively available under old tax regime and not available under the new tax regime. As far as the salaried people are concerned, they can choose between old tax regime and the new tax regime. Or rather, I would say those people who have business income can only come back from old tax regime to new tax regime once, and then cannot go back to old tax regime. New tax regime is a default regime. So in case you fail to file your income tax return before the due date, then you cannot opt old tax regime, and you have to file income tax return under the new tax regime. So in case you had opted for old tax regime for TDS purposes, etc., but fail to file the your ITR by due date, you may have to pay heavy tax because the deductions which you had considered while opting for old tax regime are no longer available. That's it. I think this in order to make the new tax regime attractive, the government has enhanced the standard deduction from salary from 50,000 to 75,000. This is available only to those who opt for new tax regime. In addition to that, For the employer's contribution to NPS, a higher deduction of 14% is available. Otherwise, for old tax regime, it is available 10%. So let me tell you, if for your own contribution to NPS, you cannot claim anything under the new tax regime, but the employer contribution up to 10% is eligible for deduction. The tax rate under the old tax regime are up to 2.5 lakh tax free, between 2.5 and 5, it is 5%, then 5 to 10, 10%, beyond 10, it is 30%. Under the new tax regime, the tax rates are, the basic exemption limit is 3 lakh. Between 3 and 7, it is 5%. Between 7 and 10, it is 10%. Between 10 and 12, it is 15%. Between 12 and 15 lakhs, it is 20%. And beyond 15 lakh, it is 30%. So all those people who are salaried and are in receipt of HRA, LTA, have home loan, etc., prima facie, the old tax regime is beneficial. But since you can switch between old and tax regime anytime, it is better to work out the tax liability under both the tax regime at the time of filing of your return and opt which offers you lower tax liability. In addition to that, all those people whose income exceeds 5 crore are benefited by new tax regime, because for new tax regime, there is a limit of surcharge which is capped at 25%. In case your income exceeds 5 crore, the surcharge under the old tax regime is 37% of the tax. That's it, I think, Sanika.
Yeah. Okay. So just now you mentioned some tax saving products like ELSS, NTS. So if we are under the new tax regime, what is the benefit for us to subscribe to these kind of tax saving products?
Good question, Sanika. See, in India, we do not have any social security which can provide for or help us during our retirement days. So whether the tax incentive is offered or not, one has to provide for the retirement days. And plus, one does not make investment decisions based on the tax consideration. Sanika, agricultural income is tax-free. But just because the agriculture income is tax-free, everybody doesn't become the agriculturalist. So you have to take into account other consideration also. And I would advise you to continue with your investment and specifically invest in investment in PPF, which offers you tax-free interest.
Okay. Okay. So what about tax that is applicable on gifts or inheritance that we get? How do we navigate through that situation?
See, Sanika, earlier there was a Gift Tax Act under which the donor was required to pay tax at a flat rate of 30% over 30,000 of gift made by him in the year. It changed a few years back, and now it has become a recipient-based tax. So now the recipient has to pay tax on the gift received. The tax liability arises when the aggregate of gifts received by an individual during the year from all the sources exceeds 50,000 rupees. So as long as the aggregate of gift does not exceed 50,000, that money is tax-free in your hand. But once the aggregate of all the gifts received during the year exceeds 50,000, the entire amount becomes taxable in the hands of the recipient. However, there are some exceptions to this rule. So gifts received from your close relatives, which includes your parents, your uncle, your aunts, etc., your spouse, siblings, spouse of sibling, any gift received from them is not treated as income at all, and there is no limit as such on that exemption. However, there are clubbing implications also. So there are clubbing provisions under the Income Tax Act under which income arising to a person is taxed in the hands of somebody else. So in case you give to any money to your spouse without any consideration, then the any income arising to the spouse in respect of that money, whether the original money or converted in any other form subsequently, gets clubbed in the hands of the donor, the person who has given the gift. And this clubbing provision continues till the relationship or the marriage subsists. Please note, Sanika, that the clubbing provisions apply in respect of the income only. And once the income has been clubbed, any investment of that income will not attract the clubbing provisions. So the clubbing provisions will apply only in respect of income generated on the original gift. In addition to the gifts received from relatives, any asset received under a will or under a personal in a succession law is not to be treated as income of the person of the beneficiary or legatee.
Okay.
So, and there is no tax incidence at the time of receiving the inheritance. However, as and when these assets are sold, the legatee has to pay capital gains tax. And for the purpose of though his cost of acquisition is nil because he has not paid anything, but for the purpose of competition of capital gains, the person who has originally paid for it, what he has paid is treated the cost of the person who is selling it. Now the tax rate for long-term capital gain is 12.5% for all assets except immovable property which were acquired prior to 23rd July, and that too for a resident individual and HUF. So in case of a resident individual and HUF, if they sell any immovable property which was acquired before 23rd July 2024, that is the date on which the budget was presented, the taxpayer has two options. Either he can pay flat tax at 12.5% of the long-term capital gain, or apply the indexation benefit on the cost of acquisition and pay tax at 20%.
Okay, interesting. So we often hear this term called tax harvesting. Is it possible for you to elaborate on what exactly tax harvesting is?
So tax harvesting is a method whereby you minimize your tax liability. Suppose you have sold some assets, capital assets during the year on which you are required to pay capital gains tax. And at the same time, you are owning some asset, but let us be specific that in case of shares, when you invest in shares, some shares may be fetching you profits, and whereas some shares may be fetching you loss. So in case you sell some shares which are fetching you profit and profits which are long term, so instead of paying full tax on the profits which you have earned on sale of the profit fetching shares, you can at the same time sell or transfer those shares which are incurring you a loss. Then because the loss can be set off against the profit which you have earned on the shares sold. So this is one example of tax harvesting. The other example is in respect of listed equity shares and units of equity mutual fund, which become long term after 1 year, you have to pay tax at 12.5%. But before the rate of 12.5% is applied, you are allowed 1,25,000 of long-term capital gain, which is tax-free. Though it is not stated to be exempt per se, it is included in your income, but a zero rate of tax is applied on the initial 1,25,000 of long-term capital gain in respect of all listed shares and equity-oriented schemes taken together. So this is another example of tax harvesting. So in case you are investing in mutual fund or investing in shares, it is always advisable to book long-term capital gain minimum of 1,25,000 every year, because that comes tax-free in your hand, and this will ultimately reduce your tax liability. In respect of shares, if you have a two demat account, then in case you want to retain those shares, you do not want to part with those shares, still you can book this profit by buying shares in one demat account and selling the same shares in another demat account at the same date, so without taking any risk of volatility. In respect of units of mutual fund, you can redeem the same day, and at that same day you can purchase also units of the scheme which is fetching you profit. So this benefit is available to all the individual, all the taxpayer. But in case you have an HUF, you can carry out this tax harvesting every year in respect of your investment in listed shares and equity-oriented schemes units.
Okay, thank you for that. So didn't know about this. Sir, also right now you mentioned the change of the long-term capital gain tax percentage. Would you highlight some other changes in the latest budget which would impact individuals?
So first of all, the finance minister in the recent budget they have made radical changes in the capital gain sphere, because that had become very complicated over the years due to prescription of a different holding period and different rates, etc. So government has removed the benefit of indexation for all the tax assets. So now you have to pay tax at the rate of 12.5% on all your long-term capital gain, except there is only one exception, that is in respect of immovable property acquired by an individual or an HUF prior to the date 23rd July 2004, where the taxpayer has got the option either to pay tax at 12.5% or 20% after the indexation. So this option is available, but in respect of exemption. So there are a few sections which prescribe for exemption from long-term capital gain if you invest the long-term capital gain in a residential house or in capital gains bonds. So section 54 prescribes that any long-term capital gain on sale of residential house can be claimed exempt if you reinvest the capital gain in buying another residential house. So earlier you were allowed to compute the index capital gain after applying the indexation on the cost and reducing it from the sale price. You would get the indexed capital gain, and you were required to only invest the indexed capital gain for buying the residential house. But since the indexation benefit has been removed, so here onward you will have to invest the plain long-term capital gain for buying a residential house under section 54. And if you wish to claim exemption under section 54 EC in respect of any land and building, there also you will have to invest the unindexed capital gain, because the benefit of index capital gain or paying flat rate of tax is available only for the purpose of computation of tax, and the indexes, otherwise the indexation benefit has been removed every year. So earlier the long-term capital gain was 10% in respect of listed security, etc., where indexation benefit was not available, and for other assets, the tax rate was 20% after indexation. Now, the finance minister has proposed a 12.5% tax rate across all the assets class without indexation, except for the immovable property, which I have already discussed.
Yeah.
Earlier, the short-term capital gain in respect of listed equity shares and units was 15%. Now it has been raised to 20%. The long-term capital gain on listed shares and equity schemes was tax-free up to 1 lakh only earlier. This limit has been increased to 1.25 lakh from this after 23rd July. And the earlier there was a drafting error in respect of taxation of debt funds. Instead of referring to investment in debt funds, the provision referred to investment in equity, Indian equity. So that drafting lacuna has been corrected, and now any debt fund where the investment in debt is more than 65% is treated as any profit is treated as short-term capital gain, irrespective of holding period. So in case the debt portion is less than 65%, then it will become long-term after 2 years, and the 12.5% rate will apply. In respect of new tax regime, as I have already explained, the standard deduction has been revised to 75 lakh. NPS contribution from employer has been increased for new tax regime to 14%. And in respect of people who receive family pension, there is a deduction available of 1/3 of pension amount or 15,000, whichever is lower. So that amount has been increased to 25,000. But all these three benefits are available only if you opt for a new tax regime. For the old tax regime, the standard deduction remains 50,000, and employer contribution benefit remains 10%, and family pension deduction also remains at 15,000, 1/3 or 15,000, lower of these two.
Okay. Thank you for that, sir. So right now during the discussion, you mentioned HUF. Could you elaborate on what exactly an HUF is?
Tanika, HUF is such an elaborate subject. It will take me one whole day to explain the various provisions related to HUF. I had conducted 2 workshops, full day workshop for FBSB explaining the HUF provisions only. But I will attempt to explain the concept of HUF briefly for the audience. So HUF is a unique concept under the income tax law. So all the persons who are covered under the definition of Hindu in the Hindu legislation, whether it is the Hindu Succession Act or Hindu Marriage Act or Adoption Act, so which includes all Hindu, Jain, Sikh, and those following Buddhism. All these 4 category of people are treated as Hindu, and only those people can have an HUF. Christians or those following Islam religion or Jews cannot have an HUF. In order to constitute, HUF needs to have minimum 2 co-partners. So let me explain what is a co-partner. Co-partner is a person who is born in the family. So son and daughters are co-partner. Even a adopted son or daughter are also co-partner. And there is another category of people who are part of HUF. Those are called members. Those members are those people who come into the family by virtue of marriage. So your mother or your sister-in-law, they all are members. So all co-partner are members, but reverse is not true. The co-partners only have a right to ask for a partition. The member cannot ask for partition. But as and when partition of HUF asset takes place, the mother gets an equal share as that of a son. The son in case of two sons, two daughters, and mother father. So in case of that HUF, each one will get 1/6 share at the time of partition of the HUF. Let me come to tax benefits which HUF enjoys. So HUF, you can have a separate income tax PAN number for HUF and file a separate income tax return, so that you enjoy separate basic exemption up 2.5 lakh in respect of an HUF in addition to all your members. HUF can claim deduction under section 80C, 80D, then for interest, for donation, all the deductions which are available under the old tax regime are available to HUF as well. As I explained earlier, that long-term capital gain in respect of listed shares and equity-oriented schemes are taxed at 0 rate up to 1,25,000. This benefit is available in respect of HUF also. So if you have an HUF as a tax entity, you can do tax harvesting of 1,25,000 of long-term capital gain every year. In addition to this, under the new tax regime, the basic exemption limit is 3 lakh, whereas under the old tax regime, the basic exemption limit is 2.5 lakh for a general category. For senior citizen, it is 3 lakh, and for super senior citizen who have completed 80 years, the basic exemption limit is 5 lakh. But for HUF, the basic exemption limit is 2.5 lakh, because the HUF does not cannot be said to have an age. So in case under HUF, if you opt for new tax regime, you enjoy a higher tax basic tax exemption. HUF can carry on business in its own name. HUF, and for conducting that business, for carrying on the business, HUF can borrow money from anybody. Even HUF can take home loan to buy a residential property and claim tax deduction in respect of interest on home loan, as well as repayment of home loan under section 8024B and 80C respectively. There is a section called it's a 854F, under which you can claim exemption from long-term capital gain arising on sale of any asset other than a residential house, provided you invest the sale consideration for buying a residential house. But the section provides that in case you own more than one residential house on the date of sale of the asset, it may be your listed shares, unlisted shares, anything which qualifies as a capital asset. But if you own more than one house, you cannot claim exemption under section 54F. So one can buy a residential property, not necessarily residential, a property in the name of HUF and get away with the clutches of section 54. So HUF, you can own one property in HUF, one property in individual's name, and claim exemption under section 54 in respect of long-term capital gain arising from sale of. So suppose you have a commercial property which is let out. So when you sell it, for claiming the long-term capital gain exemption, you have only one option, two options, 54 EC by investing in bond and by investing in House 54 app. So here you will have to invest the full sale consideration, but you can only do it provided you do not own more than one residential house on the date on which you sell the commercial property.
Okay. So, since you're talking about property and you just mentioned home loan, could you elaborate on the tax benefit that we can get on a home loan? Because very often I've heard that sometimes people say that don't pay off all your home loan. I mean, you can claim some benefit on it. So what exactly is that benefit? Spread it out.
So there are two benefits broadly available in respect of home loan. The one benefit is available under section, let me tell you, both benefits are available under old tax regime only. Under section 80C, you get the benefit of a repayment of a principal amount of home loan in respect of for buying or constructing a residential house property. And the deduction is available restricted to 1.5 lakh during the year, but this 1.5 lakh, the section 80C is crowded. So there are various items qualifying for 80C deduction, and in many of the cases, the people are not able to fully claim the repayment benefit, but still the benefit is there. You can claim 80C benefit in respect of any number of properties. The second benefit is available under section 24B. So 80C is not available under new tax regime. There is some complication for availability of section 24B interest under old and new tax regime. So 24B interest deduction is available in respect of any property, whether commercial or commercial or residential, whereas 80C benefit is available only for residential property. 80C benefit is available if you take home loan from specified financial institutions or a government authority, government employer or employer which is a public limited company. But 24B deduction for interest can be claimed even if you borrow from your friends and relatives. The deduction under section 24B is available for a maximum of 2 residential property, which you can treat as self-occupied, and deduction is restricted to 2 lakh for maximum of 2 properties taken together. This deduction for self-occupied property is not available under section under the new tax regime. The other benefit of home loan interest which you can claim is available in respect of properties which are let out or which are deemed to have been let out. In case you have more than 2 self-occupied property, in that case you have to choose any 2 as self-occupied, and other properties are deemed to have been let out. So in respect of let out property or deemed to have been let out property, in respect of deemed to have been let out property, you have to offer notional rent, though not received for taxation. So under the old tax regime, you can claim full interest paid during the year against your rental income, but the loss up to 2 lakh is allowed to be set off against your salary income or business income or capital gain, and any loss which cannot be set off during the year is allowed to be carried forward for subsequent 8 years for set off. In respect of under the new tax regime, you are not allowed to claim any loss set off in respect of home loan interest. So under the new tax regime, you will be able to claim interest only up to the amount of taxable rent. So in respect of rent which you receive, you get a standard deduction of 30%, and 70% of rent becomes taxable, against which you can claim interest paid on home loan or for money borrowed for purchase, construction, repair, renovation, etc. But in case you opt for new tax regime and there is any loss under the house property head, you are not allowed to set off. So there is difference. Under the old tax regime, you can set off loss up to 2 lakh against other income, but under new tax regime, you cannot set off again any loss against your other income.
Okay. So, what about the profits that are taxed when we sell our investments, mutual funds? How do we navigate that space with respect to trying to save our tax there?
So broadly, we have covered this question in tidbits during our previous discussion. So your house, your listed shares and equity mutual fund become long term after 1 year.
1 year.
If debt fund, then irrespective of holding period, it is a short term and tax at a flat rate. Not flat rate, at a slab rate which is applicable to you. In respect of residential house property, if bought before 23rd July and sold after 2 years, you have option of paying 12.5% or 20% on index profit. Insofar as exemption is concerned, I have already explained section 54, which is available for claiming long-term capital gain arising from sale of a residential house by investing the capital gain in another residential house. 54 applies for a long-term capital gain in respect of any other asset than a residential house, where you have to invest the sale proceeds received for the capital gain on residential property. You have to invest the capital gain, whereas for the asset sale of asset other than a residential house, you have to invest the net sale proceeds. And for section 54 EC, which is available only for sale of land and building, whether commercial or residential, you can buy capital gain bonds within 6 months from the sale of the asset. And here you have to invest only the capital gain. That is how you can save taxes.
Okay. Right now, during our discussion, sir, you mentioned the clubbing.
Yes.
Could you elaborate on clubbing of income?
So there are certain provision tax evasion provision under the income tax law, where the certain transfers are done in order to reduce the tax liability. So in order to plug those transactions or correct those things, the income tax laws have some anti-abuse provisions. So in case, as I explained, in case you transfer any asset to your spouse without consideration, any income arising to that your spouse on that asset will be clubbed with your income as long as the marriage subsists. In case you transfer any asset, you transfer income without transferring an asset. Suppose you own a house which is let out, and you you take the rent in the name of your friend without transferring the asset. So in case the rent which is received by your friend, the rental income will become taxable in your rent because you are owner of the property and you have not transferred ownership of it. In respect of transfer which are revocable, the transferor which retains the right to revoke the transfer anytime at his wish, the income will get clubbed with the income in the hands of the person who owns the property or who has initially transferred the asset. In respect of any passive income arising to a minor beyond 1,500 rupees will be clubbed in the hands of the parent whose income is higher. In case of a single parent, then the parent who is maintaining the child in his or her end, the income will be clubbed. in case the member gives any of their assets to HUF, any income or though the members are treated as relative of the HUF, and there is no taxation incidence at the time of such gift. But any income arising to the gift to the HUF on the gifted asset will be added in the will be taxed in the hands of the member who has transferred it. In case you transfer gift any asset to your daughter-in-law, then any income arising to daughter-in-law will also be clubbed in the hands of the father-in-law or mother-in-law. In case your spouse receives any remuneration, salary, commission, fee, etc., from a firm in which you hold minimum 20% voting right or beneficial interest, then the income will be clubbed in the hands of the person who owns the 20%. But there is an exception in the in case the person, in case the spouse possesses technical qualification, professional qualification to discharge the duty assigned to him or her, then the clubbing provisions will not apply. These are broadly the clubbing provisions.
Okay, thank you, sir. Sir, you briefly mentioned this before, but is it possible to elaborate on the kind of provisions we have with respect to set off or carry forward of the losses?
Yeah, so briefly I will tell, as far as capital gains are concerned, you can adjust long-term loss against long-term gain, short-term loss against short-term gain. After the netting of long-term and short-term loss can be set off against long-term capital gain, but not vice versa. So long-term capital loss cannot be set off against short-term gain and has to be carried forward for next 8 years for set off against the long-term capital gain or short-term capital gain. If you have any speculative loss includes all the transactions where the transaction is squared off without delivery. So in case you do intraday trading on the stock exchange and any profit or loss which you make on such intraday transactions, these are treated as speculative transactions, and speculative loss can only be set up against speculative business and not regular business. In respect of losses arising on lottery or digital assets like bitcoins, etc., you are not allowed to set up your loss against the any other category of bitcoin, cryptocurrency or any other digital asset, and you have to pay flat 30% tax on the profit on your digital asset. Business loss, in case you incur any loss under your business head, you cannot set up that loss against your salary income. These are all the things which cover long term. There's a losses. The loss on the house property up to 2 lakh, I have already discussed that under the old tax regime, you can set up to 2 lakh of loss on house property against your other income. But under the new tax regime, you cannot set up any loss from house property against any other income.
Okay, thank you. So, what about, could you tell us the difference between tax planning and tax evasion?
So there are 3 words, Sanika. One is tax planning, other is tax avoidance, and third one is tax evasion. So tax planning is planning your affairs in such a way, in a legitimate way, that you reduce your tax liability, like availing benefit for HRA, LTA, ATC, ATD, which are or claiming exemption under section 54, 54, etc., which the law intended to give you is a tax planning. The other is a tax avoidance. Tax avoidance is there is a thin line between tax planning and tax avoidance. Under the tax avoidance provisions, you try to exploit the loopholes in the law. So you attempt to avail the tax benefits which are not intended by the legislature to be given to you. For example, earlier the gift tax was levied on the donor, which was removed. So for certain period, there was no tax on gift tax, either on the giver or on the recipient. So people misuse this lacuna for substantial amount. Even a particular politician from UP took gifts of crores of rupees from her followers to plug this loophole. So this was not intended, and this resulted in introduction of section 56(2), which makes the gifts taxable in the hands of the recipient. And the last one is the tax evasion. Tax evasion is a misrepresentation or untruthful submission of your income records to the income tax department, and which is illegal, which is not permitted. Though the tax avoidance is not permitted, but it is still exercised within the four corners of the law. So this is the difference, broader difference between tax planning, tax avoidance, and tax evasion.
Thank you. Thank you, sir. What about, so on what basis, how do we determine that this person or this entity has to file for tax? And what I've noticed is that you have a lot of ITR forms. On what basis do you select which form are you supposed to go for?
Okay, so first let us discuss who has to file the income tax return. All companies and firms have to file the income tax return. As far as individual and HUFs are concerned, they have to file income tax return if their total income before these deductions, etc., under section 80C, 80D, 80G, 80TTA, 80TTB exceed the basic exemption limit. Basic exemption limit generally is 2.5 lakh under old tax regime. Under new tax regime, it is 3 lakh. Even the exemption which you are entitled and are availing under 54, 54, 54 EC, 54G, you have to exclude that exemption for determining your gross total income. Suppose you have sold a residential house and bought a residential house by investing the capital gain, and you do not have any other income. So since you are eligible to claim exemption for the entire capital gain under section 54, your taxable income is still for the purpose of your liability to file income tax return, the exemption under 54 which you are eligible will be excluded for computing your total income on which the decision is to be made whether you have to file income tax return or not. Any person who is resident of India, if he owns any asset outside India, if you had gone out of India for a limited period and opened a bank account and came back to India without closing the bank account, you are required to file income tax return even there is no balance in the bank account. Likewise, in case you have got any signing authority in respect of any bank account or any financial asset outside India, you have to file income tax return. In case you have incurred electricity expenses of more than 1 lakh rupees during the previous year, or have paid for foreign travel of either yourself, your family, or anybody else, and incurred more than 2 lakh, you have to file income tax return. In case you have deposited more than 50 lakhs in your bank account, saving bank account, and more than 1 crore in your current account, you have to file income tax return. So the deposit is not cash deposit. Even if the aggregate deposit by banking transactions through banking channel exceeds this limit, you have to file income tax return. In case there is a TDS or TCS of 25,000, you have to file income tax return, 25,000 or more. In case you are senior citizen, a higher threshold of 50,000 is prescribed. In case you are carrying on business and your turnover exceeds 60 lakhs, and even if you do not have a taxable income, you have to still file your ITR. And in case you are carrying on profession, the threshold is 10 lakh. As far as which form to use is concerned, you can file ITR 1, which is generally used by majority of the people. If you do not have any capital gain and you do not have any business income, and you are an individual and your income does not exceed 50 lakhs in the year, you do not own any assets outside India, you do not want to carry forward any loss, etc., you can file ITR 2. If you do not have any business income, if you, ITR 2 can be filed even for HUF also. You can file ITR 3 if you have business income. Anybody who cannot file ITR 1, ITR 2 and has business income can file ITR 3. In case of ITR 4, you can use it provided your income does not exceed 50 lakh rupees and you are opting for some presumptive taxation scheme. So the income tax provisions have some presumptive taxation scheme under which you are supposed to have earned a certain percentage of your turnover as your income. So in case of business people, 6% in case of transactions are done through banking channel, and in case that 95% or less than 95% transactions are through banking channel, then 8% of your turnover is presumed to be your income. In case of professional, and your 50% of your gross receipt is presumed to be your taxable income. So in case you fall in this category, presumptive taxable is category, you can file ITR 4. This is all about ITR, who has to file ITR and which form to use.
Okay, thank you. So what about those who have income during the year, but they are below the taxable limit? Should they file their returns? Is there any kind of benefit that they get by doing so, or it's not?
So there is no loss in filing your income tax return even if you are not required. But your income tax return filed creates a third party independent record which can be helpful while applying for home loan or to establish accumulation of wealth. Even in some countries ask for a copy of your income tax return for granting you a visa.
Okay, right. So it's a good thing to do, good benefit. Okay. And so there is 2 dates. So you have the due date and the last date. What is the difference between the two?
For majority of the people, 31st July is the due date. So if, in case you are not carrying on business, or if you are even carrying on business but you are not required to get your accounts audited, 31st July is the due date. For those who are required to get their accounts audited, 31st October is the due date for filing of the income tax return. So in case you fail to file your income tax return by due date, there is still a last date, which is 31st December in all the cases. But there are certain consequences if you fail to file your income tax return by 31st July. You cannot go for old tax regime, because then the new tax regime is default. You cannot carry forward any loss. Suppose you have a house property loss, or you have a capital loss under the head capital loss, capital gain, then you have to file the ITR before the due date. Otherwise, if you fail to file, you cannot carry forward the loss. Moreover, you may have to pay interest as well as a penalty for a delay in filing. Penalty is in the form of a late fees. So in case you miss this 31st July deadline, then you can file your ITR by 31st December, but you have to pay a late fee of 5,000 rupees in case your income exceeds 5 lakh, and in case the income does not exceed 5 lakh, then a late fee of 1,000 rupees is levied.
Okay. So, and what are the documents that are required when we are filing our taxes?
Presently, the law does not allow you to attach any document with your income tax return. However, before you proceed to file your income tax return, it is advisable to log into your income tax website and access your annual information statement AIS and also 26 AS. 26 AS has the details of tax deducted from your income, and AIS has the details of all the financial transactions which are reported by various entities like mutual fund, share broker, registrar of assurance, etc. Banks for credit card and bank transactions. So you have to verify that all those transactions are duly incorporated or reflected in your the ITR which you are intending to file.
Okay. So, and could you give us some tips to save tax?
Okay, $1 billion question. So, see, the tax planning is legitimately allowed. So you can plan your affairs in such a way that the tax liability gets reduced. So first, since the section 80C is applicable, allows you deduction of 1,50,000, and for salaried people, even the school fees and life insurance premium and the provident fund deduction itself exceeds, or even the home loan repayment exceeds 1,50,000. So in case you have a parents who are also taxpayer, you can make your parents to pay for your life insurance policy. So parents can claim deduction under section 80C in respect of life insurance premium paid for their children, whether they are married. Even the parents can pay life insurance premium for their married daughter also. So this is the one way you can do. The second is the parents are entitled for 80D deduction in respect of Mediclaim policy. So in case your tax liability is higher, your tax rate is higher, your parents' tax rate is lower. So the children are also allowed a deduction of 25,000 rupees for medical premium. And in case the parents are senior citizen, then a higher deduction of 50,000 is allowed. So the children can pay the medical premium of their parents up to and claim deduction up to 50,000 rupees. In case the senior citizen parents do not have any Mediclaim or health insurance policy, in that case, parents themselves, their spouse, and each of the children can claim up to 50,000 rupees in respect of medical expenses incurred through banking channel. So this can be used. Moreover, in case you are in a higher tax slab, you can transfer or you can gift a certain money to your parents. Like suppose you have made deposits in investments in fixed deposits or even in mutual funds and are paying taxes on it, you can transfer those assets to in the name of parents. And since there is no gift tax implication for a gift between the parents and the children, there will be no clubbing provision, no taxation, and if the parents have a lower tax slab, thereby you can optimize your overall tax liability.
Okay.
That's it.
That's helpful. Yes. I think we can just request the audience in case they have any questions. Please feel free to unmute yourselves and ask a question, or you could enter it into the chat.
Hi, Sanika, and hello, Balwan Jain sir. So I actually have a question. Now, you did say a few methods to save tax, and I think most of them apply for the old regime. With the current new regime, there isn't much provisions that we have to save tax. Is there anything? Because I am already giving almost 1 month of my salary for tax. Is there any other way that we have as a salaried person to save taxes in the new regime due to the, when we compare, it's the new regime that is sometimes beneficial, and so for few people it goes to the old regime. So any suggestion for new regime specifically?
So I have elaborately explained for whom the new tax regime will work. So if you do not have any business income, you can work out your tax liability under both the regime at the time of filing the income tax return. And even if you have opted new tax regime for TDS purposes, you can still opt for the old tax regime while filing the income tax return. So the salaried are at the mercy of the government because they do not have any discretion to reduce the tax liability beyond what is permissible under the tax planning, because the tax automatically gets deducted before the salary gets credited.
Unfortunate for us. Another follow-up question is, okay, my family, let's say my family owns a business, and but as a salaried person, is there any way that I can contribute to the business? Or I remember you telling that taxes against that you save in your business are not, cannot be deducted against the salary, so against the salaried person's income. So is there any other way that we can utilize that?
I didn't get your question.
Okay, the question is like, my father owns a business, but
Okay,
however, I'm a salary person. I'm working for another company.
okay.
Is there any way that I can use his business to my advantage to save tax or to invest in the business or any in that sense?
I don't think so. If you work and if you want to take salary from the proprietary concern of your father, you can take it. And since I presume you are professionally qualified, the clubbing provisions will not apply. Then clubbing provision only apply in case of a spouse payments made to spouse. And if the salary is paid to the children, the clubbing provisions are not applicable. So in case your father is in the higher tax slab and you are in the lower tax slab, you can take salary from your parents' business.
Avinash, I hope that helps. Do we have any more questions?
But please let Ms. has answered this question and who wants to?
Sorry, Krushi, could you please repeat? Couldn't hear you clearly.
Avinash has lost his network.
Okay. Okay.
He says that his question is answered now, and he wants to thank the speaker as well.
Okay. Thank you. So we have a question in the chat. Nanki is asking if you could suggest any long-term investments to save tax.
So broadly, all the tax saving investments are eligible for deduction if you opt for old tax regime. The product suitable to you depends on various factors like your age, your risk appetite, the goal for which you wish to save. So it is a ready-made answer cannot be given. It depends on your profile, overall profile. No, no, no. ULIP is strictly no, no. Instead of going for ULIP, because under ULIP there are so many charges. So as we advise people never to mix investment and insurance. वो बोलते हैं दुविधा में दोनों गए माया मिली न राम. Neither you get adequate insurance cover, not proper return on your investment. So for risk portion, go for a term plan, and if you are tech savvy, opt for a online term plan after comparing. And as far as the investment is concerned, go for equity mutual fund investment. If you are new to equity investment, go for index funds. So you do not have to worry about fund manager wrong decision. This way you will be able to ensure a protection under the term plan and get better returns on your investment, because equity is the only product which can give you which can help you in creating wealth in the long term.
Okay, thank you, sir. Any further questions? You could probably just wait for a minute or two and you could ask your questions or put it in the chat.
I think we are done.
In case
Khushi,
of-
what? Yeah.
Okay, thank you. Thank you everyone for joining us today. A heartfelt thank you to Mr. Balwant Jain sir for sharing his invaluable insights on personal income tax, and to our moderator Sanika Joshi for guiding the session so seamlessly. For those interested, Mr. Jain runs a WhatsApp channel on personal finance, and his contact details have also been shared. So please feel free to join the group. Additionally, we encourage you to join the Capitalize WhatsApp group to stay informed about upcoming sessions. Speaking of which, our next session will be on risk and insurance planning with Mr. Suresh Sadgopan as our speaker. It will take place on Saturday, 21st September from 10 a.m. to 11 a.m. We look forward to seeing you there. Thank you once again, sir, and thank you once again, Sanika, for the session today.
Thank you, team. And thank you, Balwant sir. It's an honor
Thank
to
you,
have you.
Balwant sir. Thank you,
My
Sanika.
pleasure. Thanks everybody. Thanks everybody.
Thank you, everyone. Have a nice day.